Hey everybody, we are in module 3 this week, focusing on chapter 4, which is gross income. I wanted to post a couple of quick videos to highlight some areas to watch in the presentation this week. Make sure that you read chapter 4. You also have the slides, which I'll be using for the presentations. The idea behind these videos is that they're quick looks at some important topics that we cover this week. As always, any questions, send me an email. You can also call or text me. We can schedule office hours whenever needed. Office hours are virtual. They're appointment-based. I am also available from 9 to 10 o'clock on Wednesdays in room 201 in the Business Center. If you happen to be in the area, I'm also available from 1 to 2 o'clock on Wednesdays in the business room, room 201. Any questions? So with that said, why don't we hop right into the first topic in chapter 4 under gross income, which is the accounting methods. So we have two primary methods of accounting for tax purposes. We have a cash receipt method, which is, to be honest, the most commonly used, and the accrual method. The cash receipts is the most commonly used method of computing gross income for for tax returns. The accrual method can be used for businesses if they have inventory. You can elect to choose the accrual method of accounting. There also is a hybrid method, which is a combination of cash and accrual, which again is often used by companies with inventory, where some items of income is on the cash basis, some is on the accrual basis. And then if we get more advanced, there's items like the installment method, the percentage of completion method, which is you can recognize income based on how much of a project you've completed, the percentage, and the completed contract method. But we're going to focus, and these methods are more about determining income. We're going to focus on the cash and the accrual basis, because this is where we see, this is where we'll see questions on the homework this week. So the cash method, income is recognized in a year it is actually or constructively received as cash, as a cash equivalent. We'll talk about in a minute what it means to have a constructive receipt. So constructively received, we'll go over that definition in a minute, but under the cash receipt method, we will count any income that is collected as cash. Just like if you have a W-2 and you're filing a personal tax return, your W-2 will reflect the wages that were paid to you in that year. If you earned a bonus or a commission that's paid in the following year, that's not included in your W-2 because the W-2 is on the cash basis. Income is constructively received when it is set aside and made available. This is often for businesses. So if a business receives a check dated December 15th for $10,000, and the business is able to deposit that check, but they choose not to, that check will be considered cash because it's constructively received, meaning the business has the ability to turn that check into cash. The business has chosen not to, so we'll include any undeposited checks as a constructive receipt, constructively received. It means the business has opportunity to turn these items into cash. Here's the example. Dr. Payne has $10,000 in patient checks that have not been deposited. One check for $3,000 from the patient who asked him not to deposit until after January 4th because her account did not have sufficient funds. Under the cash method, Dr. Payne would recognize $7,000 of income. So Dr. Payne has $10,000 of checks. Dr. Payne needs to exclude $3,000 because the patient asked him not to return the funds, not to deposit the funds. Dr. Payne on the cash basis would recognize $7,000. The income from the $3,000 check is neither actually nor constructively received because the funds are not available. So in this example, the $7,000 on the cash basis would be what we recognize because the $3,000 is not available. If we go back to another example, cash basis of accounting, December 15th, Dr. Payne sees a patient at a cost of $2,000. However, before the services are performed, the patient agrees to a payment plan that requires payment to be made within 30 days after service. The services are performed on December 28th, and the patient pays. We just moved that on January 15th. Dr. Payne could have collected the fee prior to year end. He was not yet entitled because it was not in the contract. So Dr. Payne, that would not be considered a constructive receipt. So these first two examples are examples where we're not going to consider a constructive receipt because the funds either aren't available or Dr. Payne didn't have access to those funds. But if we change those examples and we said Dr. Payne has $10,000 of patient checks on December 31st, but chooses not to deposit those checks, that would be a constructive receipt. And under the cash method of accounting, the tax basis measure of accounting, that $10,000 would be included as income because that's a constructive receipt. So again, back to constructive receipt. If the funds are available and you have them and you can deposit them, that's constructive receipt. That is income in the year. If you don't have access to the funds, like in the example where a check is dated the following year, or if you're not entitled to the funds under a payment plan till the following year, that is not included as income on the cash basis. The accrual method is different than the cash basis. So cash basis is any income received in the year plus any constructive receipts. Accrual method is any income that's earned. So it's regardless of when it's collected. Accrual accounting is similar to the financial accounting courses that we had taken previously, where income is recognized when it's earned. So inventory, I talked about inventory. So you're required under the tax laws to use the accrual basis of accounting when inventory is involved. So if you're selling products and goods, then you must use the accrual basis if inventory is involved. If the payment is received before the dispute is settled, then the income is in the year of the receipt. There's some, take a look at the slide here on the claim of right doctrine where it talks about where maybe income might be earned, where income might be included maybe before it's earned or if there's some sort of settlement there. And then we have a hybrid model, which is a combination of cash and accrual, generally used when inventory is material. So again, material based. So for example, you might use the accrual method to account for sales of goods and cost of goods sold, and then maybe the cash for others. So maybe you're a company that sells 60% of your sales are inventory related, product related. So maybe you want to use this hybrid method where the inventory sales will be based on the accrual method, which is income is calculated when it's earned. And for your other services, maybe you have maintenance services, things like that, you're going to recognize based on the cash basis, which is income is recognized and reported when cash is received. So I'm going to stop it there. And that was the first video that we wanted to talk about the differences between the different accounting methods. Under the tax legislation, we're allowed to choose between two methods, the cash method or the cash receipt method, which is cash is received, income is recorded and presented on the tax return, whereas on the accrual method, we're going by when it's earned. So do we earn the revenue? Do we earn the income? Then the gross income is recorded. So this is for slide number one. I'll have a couple more slides to follow up in a minute.